Great question, my friend. That's where you start leveling up from saver investor, capital builder investor. You've already mastered the frugal foundation. Now it's time to understand how rich investors multiply capital, even when they don't start rich. Let's break this into two big parts. Part 1: How to raise capital when you're not rich yet. You don't need to be born wealthy to grow capital. You just need to create and capture small streams of cash, then reinvest them intelligently. Here are the proven ways. Use your income as your first engine. Your salary, 7,000 EGP a month, is your initial capital machine. Save 15 to 25% consistently. Automate it before you see it. Every 1,000 EGP invested per month compounds into serious money in 5 to 10 years. Think, income builds capital, capital builds freedom. Build skill-based side income. The fastest way to raise capital is to increase your cash flow, not by working more hours, but by adding value. Examples: freelancing, writing, Excel, design, social media. Learn financial content creation or stock analysis, you're already learning that. Teach others, small YouTube or online courses in Arabic finance basics. Use 100% of that extra money for investing, not lifestyle. Recycle money, capital recycling. This is a secret of smart investors. Open quote, they don't just save once, they make the same money work again and again. Close quote. Example, invest in a small online product, ebook, digital course. Earn from it, reinvest in a dividend stock, reinvest those dividends again. That's called money velocity, capital that never sleeps. Sell idle or useless assets. Every unused item trapped capital. Sell old phone, gadgets, furniture, and send the cash to your investment account. Open quote, the poor see old things. The investor sees new capital. Close quote. Partnerships and if you trust a few people with the same mindset, pool small amounts to invest together, e.g., a group portfolio or side project, but always make rules clear, legal, and simple. Part 2: How to use debt to make money the smart way. Rich investors don't fear debt. They control it. They use good debt that builds assets, not bad debt that funds consumption. Here's the deep rule. Open quote, bad debt will cost you money. Good debt will makes you money. Close quote, let's break it down. Let's bad debt, avoid these always. Credit cards for lifestyle, personal loans for gadgets, vacations, weddings, paying interest on depreciating items. That's consumption debt. It destroys wealth. Good debt, wealth builders use these. 1. Business debt. Borrow small to buy income-producing assets. Example, start a small online business. Use debt only when you have clear, predictable cash flow to repay it. Buffett used insurance float as debt. People paid premiums up front. He invested that money before paying claims. That's the smartest leverage ever. 2. Investment debt, margin or property, carefully. Advanced investors borrow cheap money to buy high-return assets. But this is risky if not managed carefully. Example, borrow at 10%, invest in business or stocks returning 15 cents plus, keep the 5% spread equals profit. Only works if you have cash buffer plus stable returns. Rule, never borrow for volatility, borrow for predictable cash flow. 3. Productive debt, skill and education. Debt for a skill or certification that increases your income long-term equals good leverage. That's investing in your own earning power, your best asset. Golden formula for using debt, type. Example, result. Good debt, borrow to buy productive asset, income, interest. Bad debt, borrow to buy consumption, expense, income. Smart investors borrow only when the asset pays for itself. Number 3 rules for using debt to grow rich. 1. Cash flow first. Never take debt unless it generates predictable income, e.g. business or rental. 2. Leverage gradually. Start small, learn, then expand. Leverage multiplies both profits and mistakes. 3. Protect your downside. Always have savings for 3 to 6 months of debt payments. Frugality safety net. Summary: Path Frugal Investor uses it to long-term result, raising capital, create surplus from simplicity, side income, recycling cash, more investable money, using debt wisely, finance assets that generate income, controlled leverage and faster wealth, staying frugal, keep expenses low and reinvest profits, compounding freedom. Would you like me to create a visual map